the stock market has dropped down back to levels that we saw at the end of 2019, meaning that for almost a year, the stock market has gone absolutely nowhere. Is this a golden opportunity to ride the next wave higher in the markets, or a dangerous warning telling us to get out of the market before it gets ugly? So we're going to divide this video into multiple parts. We're going to first take a look at how the stock market behaves around elections. We're then going to take a look at the broader picture on the market, and that's going to give us a bias. We always trade with a bias in the market, an intermediate to long-term view, which pushes the trend in everyday price action. And then we're going to take a look at the different potential outcomes from the election and how we can potentially benefit from each situation. So we're going to start off with point number one by taking a look at the 2016 election. So we're going to zoom out and go to 2016 on the S&P 500, and we've put a blue line right here on the day of the election. You can see we had pre-election volatility leading up to the election day. We then had a strong bounce from support leading to a massive rally in the stock market. Now, there were fundamental reasons around this price action. Donald Trump talked about installing tax cuts for companies. So Donald Trump winning the election would effectively increase profit margins for the stock market, so inevitably leading to higher prices. And by the way, stick around to the end of the video because we're going to cover these kinds of fundamental forces that may come into play into different scenarios. So we're going to go back to 2004 and have one last data point that we can analyze. So we've put a blue line on election week right here. And so very similar, we've got pre-election volatility leading up to the election day. And then on election week, we have a breakout and a resumption of the bull market. Now, we're not going to take a look at all the election in history and their impact on the stock market. This is just to give you an idea of how price behaves around elections. Now, I want to show you a specific chart that's going to put all the data points in history into one chart, and that's called the presidential cycle pattern. So you can see this is the pattern in the last months leading up to the election day, and we've got the S&P 500 right above to show how they're trading relative to each other. And you can see the market typically peaks on the 3rd of September right here. Same thing happened on the S&P 500. You can't see the peak, but it peaked on the 3rd of September 2020. And then you'll typically have pre-election volatility throughout the month of September, October. You tend to have a significant bottom end of October before the rally resumes. It doesn't show you right here, but the rally resumes after elections. So this is the full pattern, the 4 years, 1, 2, 3, 4. This is the tiny section that we just looked at, peak in September, bottom in October, and this is the first day of elections where the rally resumes. And if you put this into context, it makes sense. As an investor, you want to pull out your money before a high-risk event, and once the high-risk event has passed, you put your money back in, and that creates rallies. Wall Street does not like uncertainty. Now we're going to go back to 2020 and we'll see that's exactly what we've seen so far. Peak in September, uncertainty before elections. And if we go back to the daily chart, we so far have a bottom end of October as the presidential cycle pattern suggests. Now none of this is 100%, but it does put things into perspective. So we're going to move on to point number 2 and take a look at the broader picture on the market and see if that aligns with that bullish bias around the presidential cycle pattern. So first thing I want to discuss on the broader picture is the put call ratio. Now that's something we've used multiple times on this rally and it's been extremely successful. First of all, we used it here when the put call ratio was at an extreme low. When the put call ratio is extremely low, it means there's too much fear in the markets. Everyone is short on the market, and that's a good time to enter a long trade. Here we had an extreme high put call ratio reading. We went short on the markets on the 11th of June when we had that island reversal pattern and that extreme put call ratio that marked the end of a significant rally and the beginning of a significant correction. And we had the same thing here, extreme low put call ratio reading marked the beginning of a large rally. Extreme high put call ratio reading marked the end of the large rally. So where is the put call ratio reading now? So this is the equity put call ratio going back 5 years. This is a weekly chart. You can see it oscillates up and down. This is an extremely high put call ratio reading, which is bullish, and extreme low put call ratios are bearish. The put call ratio has spiked back to the highest levels since the March crash. So let's go back to the S&P 500 to figure out what that means. If we are still in an uptrend, and that is still our bullish thesis for now, we're still making a higher low right here. So if the trend is still up, the put call ratio spiking right now would mean we've reached a significant bottom and that we're heading higher now. If we start breaking down this level, if we start breaking down below this level, that would mean two things. It would mean, first of all, we're making a lower low and we would no longer be in an uptrend. We'd actually be in a downtrend with a lower high, and we could see similar price actions to what we saw in March. And if that's the case, if we start breaking down below this, we'll start shorting the market like we did throughout the month of March. Now let's move on to the next point, and that is that you should click on the like button if you're so far enjoying this video. It only takes a couple of seconds and it really helps our videos get pushed out by YouTube to a wider audience. So thank you very much for doing that. Now, the next point we want to take a look at on the broader market picture is the market breadth. Now, we've already looked at this a few times on this channel, and this is probably one of the largest driving factors of the bullish thesis. So you can see there's a black line right here. That's the S&P 500. It's the stock market. And we've got the blue line right here. That's the breadth of the S&P 500. So it's the percentage of stocks of the S&P 500 that are above the 200-day moving average. So if there's lots of stocks above the 200-day, that means there's good breadth. If most of the stocks are below the 200-day, then that's extremely bad breadth. And there's a very specific way to read this chart, and that is by looking at the thrusts in the breadth. So every time the blue line goes from green to red in one go, that's a breadth thrust. So you can see that happened right here at the bottom of the 2000 bear market in 2002. That happened once right here in 2009 at the bottom of the 2008 bull market right here. Huge thrust. It happened right here in 2010, right after a major correction in the market. Again in 2011 right here. Again in 2016 right here. Thrust in breadth. And we can even zoom in to what happened during the election. This is, you can see the 3rd of November right there. And we have a decrease in breadth right there. So very similar to what's happening right now. And we had another thrust here in 2019 after this huge drop. So in each of these cases, I'm going to zoom back out. In each of these cases, the thrust was followed by huge gains in the markets in the years after. And so this is something we've seen in 2020. We had a brief thrust during the month of June right there, quickly spiked back down. But since then, the market breadth has been steadily improving, moving to the red line. So this looks like a healthy rally, not a bear market rally like we saw in 2008. We're going to go back to 2008 and see what bear market rallies look like. This was the bull trap of 2008. The breadth did not do well throughout that bull market. We never had a thrust in the breadth. Now let's go back to the S&P 500 and discuss the third and final point of this video, and that is the different potential outcomes from the election and how we can benefit from each situation. So the first potential outcome is a contested win. This is not the highest probability outcome, but it is something we need to discuss. This could delay stimulus talks further, and it would definitely decrease the efficiency of the government to provide help to a fragile economy in the weeks following the election. We believe this is an extremely important time for the economy to have stimulus. A contested win would likely delay that and could trigger more downside and break this support level. This is the worst case scenario. It is something to consider, but this is not what we're betting on just yet. We can take a look at the 2000 presidential election. So let's zoom out and head to 2000. This was the election week right here. Now you could argue that the dot-com bubble had burst and that this was pushing the markets down, but having a contested win definitely added uncertainty into the stock market and increased the selling pressure. Now, potential outcome number 2, a Biden win. For now, this is the most likely outcome, although we're not going to pretend to be able to forecast elections. So for now, this is a potential outcome like all other outcomes. In this case, we have 3 main points that we're looking at if Biden is elected. First of all, there is China. Joe Biden will likely loosen regulations on China. Any stock that has a consumer or manufacturing market in China will benefit from a Biden win. This is something we discussed on gameoftrades.net yesterday on the weekend update of the market. We discussed a few trade ideas on particular stocks if Biden would win or Trump would win, which is the next potential outcome. The next point we're factoring in is renewable energy. Renewable energy, this is one of the key differences between Trump and Biden. Trump is focused on the crude oil economy, while Biden is focused on transferring to renewable energy. Solar energy stocks will likely to continue outperforming if Biden wins and will likely take a hit if Trump wins. In fact, we can take a look at XLE, and this is something we shared on our Twitter account. Throughout the past few months, we've had a massive correlation between the likelihood of Biden winning and the price of XLE, which is the energy sector of the S&P 500. And you can see the likelihood of Biden winning is inverse to the price of XLE. Now, the last thing that we're factoring in to a Biden win is a large stimulus package if we have a Democratic sweep, which we believe is also a likely outcome. It is no secret that the Democrats have a larger inclination to government spending, to increase government spending. So a Democratic sweep would increase the probability of a large stimulus package, which could make stocks rally very quickly and gold to also rally. Now let's get to the last potential outcome, which is a Trump win. Now, a Trump win would likely mean that stimulus will be enacted quickly. So again, stocks would rally and gold would rally as well. In either case, potential outcome number 2 and 3, we believe stocks will rally higher. The only case where that is not the case is a contested win. Now, the biggest trade to be made on a Trump win is XLE, as was said before. With a Trump win would trigger a massive rally in XLE, in crude oil related stocks. Now, before ending this video, make sure to go and check out gameoftrades.net. The link is in the description below. We cover everything in trading and investing on stocks, the US markets, cryptocurrencies, precious metals, education, commodities. We've recently put out trade ideas heading into election week and a full analysis of what the dollar breakout means for gold and silver. So make sure to go and check it out. We now have a free trial on the Pro membership for 7 days. So that's about all I wanted to cover in this video. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.